Good afternoon, everyone. Thank you for joining this webinar organized by the Hong Kong Trade Development Council. This is the 15th series of the Asian Financial Forum. Today, we have two very knowledgeable speakers on the topic of green finance. Let me introduce myself first. I'm Sammie Leung, a partner from the ESG Services based in Hong Kong, PwC. Next to me, we have Grace. Grace, you want to say a quick hello to the audience?
Hi.
Grace is the head of the Green and Sustainable Finance and the Hong Kong Stock Exchange. She also has pioneered a number of ESG key initiatives in the Hong Kong and also Asia market, has been influential to the market, which we will elaborate more on what she has been doing. Also, we have Mervyn. Mervyn, you want to say a quick hello?
Hi, everyone.
So Mervyn leads the strategy across the Asia-Pacific region of Schroders, and he will be sharing of the insights and the thinking of from the asset management perspective as an investor. What could we expect around green finance in this next version on X investment? So with that, today we want to focus on the climate change, the carbon version of the business model, which is a very hot topic both in the public sector and also in the private sector. We will be spending time to talk about roles the financial sector would be playing. Why people keep talking about it is a key enabler or even an accelerator. So we will dive into some specific example, how the asset manager and the investor have been using the methodologies or tools in evaluating this whole climate change aspect from risk and also investment process. And then we'll also spend some time on a very newer or a relatively newer topic, which is the carbon market. Some of you may be seeing some news in the public news information, and we are very happy to have these two speakers to share with us what they are thinking, what they are seeing, and what should the market be expecting. How could we get prepared on all these exciting initiatives? So with that, let's dive into the part one, the role of the financial sector. I'm going to ask our two speakers to talk about the role, the involvement of their respective organizations have been playing. Before that, I'm just a quick one-liner about what PwC has been doing in this topic. The market is familiar with our job has been our work has been spending time with clients around ESG information disclosure, that sort of more familiar areas. We also have been helping clients to set their climate strategy, net zero target, decarbonization, and also we walk the talk and we have set our net zero 2030 commitment. And we also try to influence our supplier. And we lately has been verified by SBTi of our 2030 commitment. So that's a quick overview, one-liner of what PwC has been doing. Now let me turn the time to next to me, maybe Grace, you start first.
Thank you, Sammie. First of all, good afternoon, everyone, and good morning for those joining us from Europe. I'm very pleased to be here, and I wanted to thank PwC, AFF, and HKTDC for organizing this panel. So you asked earlier, what's the role of the finance sector in relation to whole decarbonization? I think that the finance sector is where all the money is and plays a critical role in the net zero revolution in order to limit global warming to well under 2 degrees. This will require a massive reallocation of capital, which I'm sure my colleague Mervyn here will talk about, in order to ensure the long-term sustainability of companies and portfolios. You may have heard that the United Nations Environmental Program Financial Initiative, they estimated that for full decarbonization, the world needs about $5 to $7 trillion per year. This may sound staggering to you, but did you know that tens of trillions of dollars are spent every year on exploration, extraction, refining, and transporting fossil fuels, as well as building, selling, installing, and using things that burn fossil fuels to generate electricity, transport people, and goods. So for policymakers, we and many other people in the finance sector, such as asset owners, asset managers, investors, insurers, and other service providers in the industry, they must start redirect capital flows towards a massive expansion of renewable energy, electrification of other end sectors, and improved efficiency. It also requires a better coordination between these finance players, financial, supervisory, and regulatory bodies, and those in charge of environmental policies. In Hong Kong, our Monetary Authority and our Securities Commission set up a cross-agency steering group with exactly these stakeholders in the regulatory function in the finance sector and the environmental sector in order to coordinate the management of climate and environmental risks, as well as to accelerate the growth of green and sustainable finance in Hong Kong, and to support the government's climate strategies. The steering group has been running for over 16 months now, and a number of concrete steps have been announced as a result of such great collaboration and coordination. Shall I go on to talk about these things? Or maybe it's a time for Mervyn to talk about the role of asset managers?
Absolutely.
Thank you, Grace. Again, very happy to be here. It's very exciting to talk about this climate risk and carbon markets. I guess in terms of why we're here, for Schroders, ultimately what we're here to do is to serve our clients, and that's helping them achieve their investment objectives. Historically, that's risk and return. Increasingly, there's an element of impact in there as well. And Grace has talked about, with decarbonization, net zero pledges, lots of governments, companies making these promises, it's going to mean huge shift in what the world looks like. The way that we generate electricity, the way we travel, the way that industrial processes are created, it's going to mean a huge amount of things. And what it means as an investor, as a steward of capital, is to really navigate for our clients through this changing world. Because when we're talking about, and I think risk, return, and impact, because of all these changes, there are going to be opportunities that come out of it. The companies that have the necessary technology, the ones that are really helping to decarbonize, are going to benefit from this decarbonizing world. Whereas the ones that have historically been profiting off emitting a lot of carbon, having a lot of negative externalities, are going to feel those externalities internalized back on their balance sheet. But not every client cares just about risk and return. They also care about the impact. They're thinking about how they are also part of driving the world towards a better, greener place. And we work with them on that as well, thinking about how do we build an active ownership and stewardship framework to lead companies into a kind of setting decarbonization and getting themselves on a transition path. And I think, of course, if we're talking about companies, we also have to talk the talk ourselves. And so Schroders, in terms of our own commitments, have signed up to the Net Zero Asset Management Initiative, as well as the Science Based Target Initiative. They're sort of two sides of the same coin. One is about getting to a Paris-aligned temperature scenario by 2040, in our case, 1.5 degrees. The other about reaching a net zero portfolio by 2050. But to actually succeed in that, it's about taking the world's companies to that low carbon journey so that we actually are able to achieve a net zero portfolio in the future. And so I think that's what we're here to do as an investor.
Very well said. Grace, you want to say something?
Yes, because I haven't really talked about the exchange's role. So I think
I'll
that
allocate the rest of the hour.
I'm so impressed by what PwC and Schroders have done. For us at the exchange, we have also done a lot. As a market regulator, we have been upgrading our listing rules to require more climate-related risk disclosure and also social risk disclosure. We have now more than 2,560 companies listed on the exchange. And there is a momentum of helping these real economy companies to have better disclosure, as well as a pathway of looking ahead of what it means to be net zero. As an exchange operator, we also facilitate the creation of a vibrant, sustainable finance ecosystem through partnerships, access to resources, and to support a range of sustainable finance products to enable businesses to accelerate their sustainable journey, and for investors to diversify their portfolios. As a corporate, we're also committed to leading by example in terms of sustainable initiatives. So, for example, our colleagues in the London Metal Exchange have introduced responsible sourcing requirements such as steel and aluminium. So to sum up, I think the risks represented by the climate change share many characteristics with the risks associated with the financial crisis and corporate governance irregularities, in relation to which stock exchanges have already made meaningful interventions. So stock exchange has a significant role to play in identifying and reducing risks, thereby protecting the integrity of and trust in the financial markets. At HKEX, we believe it is our duty to create a stable, healthy financial infrastructure in order to support the transition to a low-carbon, climate-resilient economy. To that end, we also work closely with companies, investors, and others such as the United Nations Sustainable Stock Exchange Initiatives and the World Federation of Exchanges Sustainability Working Group. Thank you, Sammie.
Thank you, Grace. I spent quite a lot of time with the listed issuers, with asset managers, with asset owners, and also with our policies makers, financial sectors, and also non-financial sectors. So hearing from what Mervyn has said about serving the clients, that's also what we focus a great deal in PwC. And what Grace articulate, the role as an exchange. I had the front row seat witnessing the impact in terms of certain policies and certain changes. While back then, maybe a few years ago, the market might not really have a good understanding of why we are doing certain actions. But I do have the front row seat to witness the changes, the momentum, and now we are seeing some of the progress. Back then, if we're talking about ESG disclosure, nobody really understood that. 2013, 2014, and then now these days, even yesterday, the day before, media, the press was asking, so how are you seeing Hong Kong ahead? Oh, it depends on which moment you're measuring us. But yes, we are ahead for a few terms. And when we are being asked about the emissions, now everyone is talking about carbon, opportunities. It wouldn't happen to actually have something to talk about carbon if we did not disclose and measure the emissions. So certain decisions was made a couple of years ago after a group of professionals with a lengthy, really hardworking, all the efforts, while the market maybe only 5% of the individuals understood that, but many of us have been experiencing the changes, why there are so many webinars, money involved, why we are seeing the AUM increase from 31 billion back in 2016, and then people were, wow, it's like almost close to double in 2-3 years' time because of all this momentum. So I want to make a point that the other day someone was asking, why finance is driving this? As a professor's question, and people got heated by who should be driving that. I don't think there's certain people driving that because we all are sharing the planet, meaning not in the NGO perspective. Yes, we are for profit. Yes, I enjoy every single moment that I'm serving my clients, but there are no contradiction between doing something meaningful, addressing climate change, and yes, no particular sector has all the solutions, but maybe relying on public policy is not the only way. So that's why finance sectors would play a role, because from what I'm seeing in the market, corporations, oh my gosh, they love listening to the investor. One line that you guys said to them is so much more powerful than, wait a minute, that's the Appendix 27 of the listing rules. The reaction is just different, and similar momentum that I'm seeing myself from the corporate customers, OEM clients that they need to do a lot. Suddenly, a privatized company suddenly need to urgently do something about SBTI because of their European American corporate clients ask them to do it. So I hijacked sort of 2-3 minutes, but I want to at least set the scene why we are discussing finance sector's role. It's not because we think we have all the solutions, and I don't represent the finance sector. I serve all the clients from different sectors. But we do need money when we transform, and we share the same total amount of natural resources, and we all share we are all facing the same climate change. So the emission here would impact the emission there. That's why the investor and the banks need to influence the real economy. So let me probably pass the time to Marvyn to elaborate in his house, some of the dialogues that you might be having with your portfolio company. What would you suggest them to do? How you enable them? That sort of real life stories.
Absolutely. So I think it's interesting you talk about finance being the driver. I would say what's the real driver is the recognition of the potential physical risks we'll face if we don't actually go through with this decarbonization. I think the ECB talked about, even if the transition risk is painful and looks painful now, a physical risk, high physical risk world would be much, much more painful for companies. And that's the real reason why we're doing it. I think we have an increasing, I think, stakeholder consensus, be it government, be it finance, be it the general population, that this climate risk is becoming more and more real. And so, okay, how do we actually avoid this world? And that's where the net zero targets and commitments start coming in. But I think we've seen with the Paris Agreement, after the Paris Agreement was made, there was not actually that much policy to take you to a 2 degrees or well below 2 degrees world. Like what you actually need is policy action. You need companies to start taking action, thinking about investment, moving towards renewable energy. There's a whole roadmap you can potentially take, but you need to take those actions. And so while we're encouraging our kind of portfolio companies to set targets, we're also asking them for a definitive transition plan. So in terms of Schroders, our CEO, Peter Arison, actually sent a letter to the largest UK companies, everyone in the FTSE 350, on exactly that, detailing out that transition plan. Because if you say you're getting to 1.5 to 2 degrees, what as an investor we care about is, what does that mean for your business model? What does that mean for your company? It means something very different for an airline or a steel company, which is actually very hard to abate those emissions. You maybe can move to a more efficient fleet. You might be able to use low sulfur fuel, but realistically, the technology is not quite there yet. So you may have to use offsets. For renewable, for an energy company, it might be moving the energy mix towards renewables, but you need a path to get there. It doesn't happen overnight. You need to make investments. Potentially in some other sectors, you need R&D. So we are pushing companies to really lay out the detail of their transition plan, because that's the only way then we can think about it from an investment perspective. And as I mentioned before, that's looking at the risk, the return, as well as the impact of holding that.
Thank you for outlining the approach. If I may ask you to elaborate a bit more, so they give you the plan, probably with some timeline, and I'm sure within the universe of all your holdings, and there are some sectors that you already mentioned, some that they will take longer. And then, to the extent that you could share without getting into too much specifics, was, from the asset manager perspective, what your asset owner have been expecting, how aware they are. Yeah. And I'm sure there are gaps that the portfolio, it's too painful, we can't make that happen. So how do you balance this gap?
I think there's many sides to this question. We've had over 20 years of sustainable investing experience, and despite a lot of resources and time on this question, it's still very complicated. And let's take it. So you mentioned okay, we have more disclosure now on scope 1, scope 2, and increasingly scope 3 emissions. That is definitely helpful to understand carbon and how it interacts in the business model. It doesn't actually give you every answer. So let's take an example of a wind turbine manufacturer. If I compare it to, say, a lot of its sector peers, or actually just across an index, its scope 1 and scope 2 can be quite high because it's manufacturing that wind turbine, right? Mm-hmm. And then actually, when we're thinking about what a wind turbine actually does, it's one of the essential sources that enables system-wide decarbonization by moving, by allowing wind energy to replace a more fossil fuel intensive fuel source. So if I just looked at a carbon footprint of a portfolio, if I just did kind of looked at, if I thought about ESG purely in the form of quantitative metrics, this wouldn't capture. So we start having to build our own analysis. So, and I think in this particular context, the concept of avoided emissions, thinking about how do we actually get to really support companies to decarbonize? How do we really think about risk and opportunities? In the sense of a wind turbine, like because it contributes to decarbonization, it's a potentially massive growth area when governments try to move towards a much larger share of renewable energy. And we really need to think about that. And so when we start talking to clients, there is a huge range of different levels of sophistication. So some are asking, what is ESG? Why are we thinking about this? Some are going, we really understand climate is a big change. Like the existing tools don't really capture what we're wanting to do. Tell us how to think about it, work with us to really push the boundaries further. And so we're really just working with kind of our clients in a way which kind of caters to helping them educate as well as working with them on kind of thought leadership and front line of ESG investing.
Right, thank you very much for that specific example. And I think you that example also helps us, and I wonder if Grace would agree, that the rating or some of the assessment, oversimplifying is actually not really fruitful. While we don't want to complicate things, but the whole topic is just multi-layer and pretty evolving, and there are basically no shortcuts in analyzing the decarbonization journey, or in the risk language, that to really do your proper homework in analyzing your portfolio, whether you are selling ESG investment products or not. You simply should be analyzing the market trend, the sector, the risk, and then look into, therefore, to your point that the scope 1 and 2, whether or not it is reflected or not, needs some proper homework. And those type of input would not be something easily you could just subscribe some rating and get the results. Yesterday, there was a very lengthy debate, and because many of the market practitioners were just hoping me recommending this rating or that rating would be making their lives easier, because people are struggling with the conflicting rating results of certain say utilities company, and they need help in trying to make their whole box ticking exercise easier. But I think that example actually proves that the quantitative results or not understanding the business model sufficiently would then you overlook, wait a minute, that may not be just scope 1 + 2 equal, then for you to optimally formulating the decision. So anything you want to add, Grace, from your stage perspective or what you're seeing in the market?
I probably want to come back to
Please,
that
yes.
example first, because I was intrigued when I read in the news, I think it was last week, that because of climate change, there's not enough wind in the UK to drive the windmills. So even though companies are trying to transition to other types of renewable energies, there needs to be a need or even a crystal ball to see what's going to happen to wind power or hydropower if we don't have enough water. So do you guys look into that as well?
Yes, absolutely. And I think when we're thinking about any exercise that involves trying to predict what the world looks like in 30 years, 50 years time requires a huge number of assumptions, right? And if we so there's this whole concept of marginal cost of abatement in the carbon world, which is how much effectively does it cost to reduce a unit or ton of carbon? And if we take something like electric vehicles, your estimates can range hugely different depending on what you expect the evolution of battery technology and pricing looks like. It will vary if the price of gasoline changes, which kind of will be affected by things like carbon prices. It could be affected really just by, I think when we're thinking about mining of cadmium and nickel, the inputs of the batteries for EVs, that's another factor. And so, and then I think then you have to think about the overall fuel mix, because if you move from, let's say, internal combustion engine vehicles to electric vehicles, you're only going to decarbonize if the rest of the grid decarbonizes, right? Because it's the, how clean your electricity is. So within every estimate and every conversation you're having about climate, there is all these assumptions built in. And I think you've got to recognize that. And it's not this, like having a precise score of 80 versus 82 or AAA versus BB doesn't necessarily tell you that much about your certainty of your evaluation.
So I think what it boils down to at the end of the day, it is about disclosure. And having consistent disclosure is what's important. And I'm really proud to be in Hong Kong because we are probably the third jurisdiction to announce mandatory disclosure using TCFD, which is the Task Force on Climate-Related Financial Disclosures. That's going to be mandatory 2025, but we hope that there'll be more early adopters to start disclosing using TCFD. I think that will, everybody looking at the same set of data, that would help asset managers to do the analysis. The other thing, obviously, is it's all the risks that will come into transition risk, as you said. You know, we need to think outside the box. I mean, who would have thought, you know, there'll be an ad in the UK papers for lorry drivers because there's just not enough drivers, so to ship the fossil fuel to whatever. So yeah, I mean, we have to basically really relied on PwC and other advisory firms about looking at all sorts of risks.
Thank you. We do a lot more than disclosure and advisory and accounting and assurance and risk and decarbonization. And we would love to get our hands dirty and actively participating. And Marvin mentioned the EV. I also spent time hanging out with a startup who are dealing with hydrogen economy, which I probably understood like 30% of what they have been talking about, all the fuel cells. I have to bring some younger colleagues that, you know, that they have the fluency of all that. So I think, you know, and I want to react to, I'm also extremely proud to be a Hong Kong-based professionals. Not only we have the policies and we have the talents, we have the products. And I think, Grace, you once mentioned we have the right ingredients. While the market players may not fully comprehend the possibilities that it could create, but with the scale and with the market and with the demand and with the agility that us having, really, really positive of the next wave of all these climate, you know, risks or opportunities. Both are, you know, a lot to expect to. But before I move on to part two, just one real quick, if we are trying to give some key takeaways or what people should be aware of, probably if you're an asset owner and if you're interacting with your asset manager, or if you are an investor and individual ones, and if someone try to oversimplify and give you a score and try to draw some conclusion, that's probably something you might be aware of and think about the interconnectivity of different sectors and different policies. A mainland-based partner earlier was on the phone with me, and he was halfly joking, and he made a remark about, oh, now that we are seeing what transition risks mean by, we talk about so much policies change and look at what's happening in China and the utility supply and all these policies change. It could be a journey while we are still discussing what's the right approach. Complain about lack of data and lack of talents and capability, but there are certain markets, actually, certain policies change would really make some drastic changes within a very short period of time. And probably if we don't do our homework and analysis, or if we don't see the interconnectivity with different markets and sectors and the risks and opportunities, you probably will be stuck in missing some of the black swan events, and they are not really that black swans. You know, people have been talking about it for ages. Now, shall we move on to part two, the carbon market? Just checking, anything to add? We have 30 minutes left, so Grace, the news and, you know, a lot of the excitements have been generated. We are seeing the July 15 announcement, the 7% stake in the Guangzhou Future Exchange. That this is also one of the reasons why earlier I said that we're extremely excited and being proud as a Hong Kong-based practitioner. So any update you want to share with us?
Yes, sure. I mean, the July announcement of the cross-agency steering group is important because, again, it stated that climate disclosure is going to be a priority. But also, we announced a work stream that will take care of carbon market, as well as a joint center for green and sustainable finance. I know you talked about ESG talent earlier. I think in order to grow the market and to have more people that can help Mervyn to do the analysis, we need to upskill and reskill and even have degrees in relation to sustainable finance so that we can groom more people that can support this market. So the joint center has a capacity building working group looking at talent and other things that will help the industry. The other working group is a data management. So again, we're working with market participants to come up with some recommendations to the cross-agency steering group. Hopefully there'll be some more announcements later on this year. But back to carbon market, most of you may be aware that in July this year, China has started their national compliance carbon market. And the trading is currently for the power sectors only. The compliance market is really important in China because obviously China is one of the biggest polluters, but it's also one of the biggest renewable energy providers. Now, the coverage of the national carbon market is already twice the size of the EU emissions trading scheme. So I think there are lots of things that will happen in this important new asset class. But looking at what's going to happen to China with the regional emissions trading schemes, what will happen after all the X sectors that are going to be joining the national market is something that we are keeping an eye on. And also, you may have heard that the task force on scaling the voluntary carbon market, it's being led by Tim Adams of Institute of International Finance, Mark Carney, and Bill Winters of Standard Chartered. They have recently announced a governing body and really focusing on having a standards, a governing body, as well as how you look at whether a carbon credit is of a high quality or not. So in Hong Kong, with all these developments, we set up this work stream to see how we can help, giving our risk management expertise in Hong Kong and also our ability, bringing international investors into China, what kind of a role we can play in the compliance carbon market in China. But in relation to the voluntary carbon market, I mean, for those of you that are not as familiar, these are what you call the, all the carbon projects, the technology projects that Mervyn was talking earlier, windmill farms, hydrogen, carbon capture technology, reforestation. These projects, they need money, they need capital. So at the moment, let's just say Amazon forest, for the indigenous people to save their forests, there's just no reason for them to do so because it's only $2 per carbon offset at the moment. But if this was raised to $50, then it drives them to protect the forest as job opportunities, as well as you can create a community. So I think developing the voluntary carbon market by the private sectors is absolutely essential. So we, Hong Kong Exchange, as well as our Securities Commission, we are doing a feasibility study looking at this in the Greater Bay Area as well as internationally. So it's a good development. And thank you for keeping up with our news. The 7% of the Guangzhou Futures Exchange, it's an important partnership from exchange perspective. We are the first non-Chinese entity to be able to invest in an exchange in China. And we recently also signed an MOU with them to look at collaboration in relation to carbon and other commodity products. Thank you.
Thank you for the update. I think we're all very excited that market practitioners is my personal interest and also my job to keep up. And also our clients and have also been pretty keen to stay close to the matter. And I think days ago, the task force, I think one thing around ESG is there are just so many acronyms and so many frameworks that and it's so hard to say it fluently. So let me speak about it slowly. Again, the task force you mentioned is called the Task Force of Scaling Up Voluntary Carbon Market, TSVCM. Trying my best to speak it more fluently. So they also have the update getting the governance body right, and they would be finalizing the principles. You mentioned about, and also it's on the news, the compliance market and the voluntary market. I think in the market, certain expectations or sometimes anxiety is about you going to tax us or for certain more educated or experienced seasoned professionals, maybe Marvin's you're at your house, you guys are having the habit to doing some analysis to have some carbon pricing as your part of your analysis. But then when people heard about compliance market, and naturally there will be rules, regulations, and then traditionally for people who have been following the voluntary market, then as long as they heard about the language offsetting, then it rings some red flags, and there are worries or fears about how trustworthy are those projects. In many cases, the projects are in certain more emerging markets or rural areas, so we couldn't expect the data reliability or the traceability of all these details. When we have money involved, then the instruments or the credits, the money that we're talking about, it will be very, very lengthy efforts to actually translate to something we could put it on an exchange, just trade it and get someone to do the clearance and the settlement. It probably needs a number of years, I don't know. So I'm dying to hear what Marvin's have been feeling about this.
So I guess I could maybe summarize what you said. I do agree that in some ways with ESG and carbon and climate, you feel like sometimes you're swimming in a sea of jargon. Like it's so many different words, everything's so complicated. Like I can barely decipher the meaning. But maybe like let's get to kind of top level. Let's start with why do carbon markets exist and why do we have voluntary and compulsory markets? Carbon is a negative externality. It's causing negative social impact. Through regulation or through commitments, it's now being priced. You have emission trading systems like China and Europe, and then you have companies saying, I want to be net zero, but maybe I can't bring my emissions down fast enough, so I need to buy some way of offsetting it, so I invest in projects. What it means for companies that kind of like, who are really thinking about this is at the rate that the policy momentum is going, the way that commitments are being made, carbon's going to get more expensive. If I'm emitting it, I am going to have to pay for it in some way. It's going to become a cost. And to really think about it, then it's, okay, well, if I have this cost that I have to deal with my income statement, potentially my balance sheet, but I'm thinking about like stranded assets and carbon assets, how do I take action on this? And that's when we start thinking about carbon markets, carbon futures, carbon everything like that. It's about what can I do to hedge my future exposure as carbon prices go up? Can I buy a future? Do I want to bet on carbon prices not going up? Do I want to tailor my investment portfolio so it has some kind of positive correlation with carbon? So something that benefits from a world of higher carbon prices. So if I'm investing in something like energy transition technology, for example, you can see why like those things could be linked. These are real world business impact, right? So like we're not creating ESG, we're not creating carbon markets for the sake of it. This is about trying to manage this business need. And I think that's why companies need to understand this.
And how do you see the your peers or putting yourself, your firm, UK based, maybe you're more familiar, and also the expectations from the asset owner. So you probably have been having similar dialogue doing the internal analysis for a few years. And if we use a, I don't know, 10-point scale, just to generalize the maturity, where are you, if you don't mind me asking? And then, compared to your peers, maybe in Hong Kong / Asia, where are we?
Very fair question. It's again, it's a very complex market, and you can break it down into lots of different bits. But I think Grace mentioned, with terms of at least, let's take offsets for example. Reforestation, afforestation, forestry assets is a key part of is a key asset that produces offsets that can be used in some of these voluntary credit markets. So how much offsets does a piece of land generate? That is a really complicated question. So it can depend on how you plow, what kind of trees you plant, how I manage it. It's no simple task. And so the only way as an asset manager we can learn and do more about this is to get more data and expertise. So we invested in a company called Natural Capital Research, which really kind of uses both spatial analysis and AI analysis to understand what is this offset potential of different land. But not even offset potential, because I think one of the things that people talk about ESG, everything links to everything, right? If I plant trees, it's going to affect flood control. It's going to affect different parts of biodiversity. We need to understand all these impacts. And so it's a really complicated answer, which we are doing, which we're trying to, well, it's a really complicated question, which we're trying to answer by getting more data and more analysis.
Thank you. You didn't, I think I should apologize for asking you to put the maturity into a 10-point scale, because 5 minutes ago, it was me who talked about whoever tried to be aware of those people who try to oversimplify things and trying to rate something. And your remark about everything is linked, and that's so true. And we are trying to before we could actually talk about trading something, we talk about monitoring something, and then but we haven't really got the method consistently to measure something that we never really measured, and that's the natural capital part. That's step one. So while we could be and should continue to be excited, I think back to the talents point and back to the whole awareness, or how could we do a better job in mobilizing different sectors and experts and input to really work together, is to at least get the 101 portion better being understood. Otherwise, people fear about we are being behind, or we are not ready. If you put some regulations out there, people say, I'm not ready. If someone sees some markets out there, oh, why are we behind? So before we could judge, we probably should at least get the 101 basics out there, so that we could at least talk on a more understood and with some substance.
I absolutely agree, because carbon markets actually have quite difficult to understand, especially when there's so many different types of projects, right? You have carbon removal, carbon avoidance, and there are different standards out there. Which standard is better than the other one? How do you monitor, report, and verify these carbon credits is another area which require a lot of expertise. And so that's why, I said about ESG talent. We also need carbon talent. We believe that, as I personally believe that, it's going to be a new asset class. You will need advisors, for example, to listed companies as to how much to buy, where to buy from, how long to keep it for before you retire these carbon credits. And as Mervyn said earlier, how do you manage, how do you hedge your risks? You naturally have to buy futures and options. So it is going to be a market that needs a lot of education. We need to educate our listed companies, we need to educate regulators, ourselves, and market participants in general, because we haven't really traded this in Hong Kong, for example. Europe had a bad experience back in 2008, and there are a lot of uncertainty about the voluntary carbon market. So that's why the TSVCM is so critical in creating fungible carbon credits around the world. I'm really looking forward to more of their announcements at COP26.
Right, thank you. Absolutely. Share the same views, and thank you for that meaningful dialogue. To at least share, maybe we spend 2-3 minutes to help the audience to get a better grasp of maybe yeah, there are a lot of frameworks, jargons, the compliance and the voluntary. If we stay on the voluntary markets, then we are talking about an organization, they are voluntarily trying to fulfill their commitment, which Marvin was alluding to. And then if someone managed to measure the carbon, and then they follow all the internationally allied framework, and the frameworks, for instance, we are talking about gold standards or VERA. These are the more commonly used adopt frameworks, and we are talking about you could go sell if you have the carbon credits to sell, and they would have a registry, and that's how people facilitate the trading. But at the moment, these are voluntary, meaning that no one pushed the company to do that. They do it because they want to reach net zero, which Marvin was mentioning. And then there are obviously then if you, oh, I'm paying someone and it's not regulated, then people could be nervous. But we could also work together to refine. And that's the task force that Grace mentioned about talking about what changes, what actions recommended could help the upscaling or the scaling up, which could be at least have some consensus of what type of projects are legitimate. And the pain point that everyone understood the pain point, and they are working very hard to move towards to a more workable version. Additionality. So we're doing something additionally as opposed to business as usual. So you're avoiding further emissions, or you're moving someone. That's what the areas are about. So for the audience who are interested in trying to get involved, at least you could look up those attributes. And I'm sure in the short term, there may be white paper, innovative competition, or you could start your own firm. Everything is possible these days, but at least there are like attributes that to facilitate and enable the market so that different parties could, through the brokers, through the platform, and they could trade. And that's the voluntary market that we are talking about.
So I'll throw you another acronym then.
Please, can't wait.
So looking at the TSVCM, and I agree with Sammie that it's obviously all available on the AFF.com. The acronym is actually valid. So you mentioned additionality, so it's verifiable, additional, and prevent leakage, irreversible, and avoid double counting. So yes, that's a new acronym. So this is how TSVCM suggests that carbon credits should be looked at.
The other day, my colleagues and I, we were talking about wish lists, and that was one moment that we said, we wish people would stop creating acronyms, but I actually like the one that you mentioned, because I read the version permanent, but irreversible is like, it actually works, which means for the audience who didn't spend as much time as we do on the topic, the good news is there's a lot of information free of charge out there. Knock yourself out, enjoy, have fun. But also those are, if you think about it, those are very common sense type of nature. We're talking about, if you say that carbon deserves to be qualified as a credit, then we're only talking about if you're planting a tree, then it may or may not work, because you need to think about what if the tree dies. That's the permanent or irreversible point that we are talking about.
That's why you need green insurance.
A lot of, that's why it's a multi-sector.
Absolutely.
It's a multi-sector. Everyone could find a role to play. Mm-hmm. It is a very interconnected topic. I was not very focusing on or being rude in looking over the iPad when they are talking, because I also have the job to look at the questions coming in. So thank you for those who have putting your questions here. And let me just read it out for the first question. If we want companies to start disclosing climate risk in the annual report, which can only be future projections, how can we address the risk of false statement when sustainability information does not have their own audit standards? How can investor manage this risk better? So the questions is around climate risk disclosure, and it has a projection of forward-looking elements. So how could we address the misstatement if currently is not required to be audited, and how investors manage these risks. Any
I'll let Mervyn talk about from an
and
investor's
leave me
perspective.
15 minutes to also respond to that. Just joking.
I
Go
mean,
on.
it's one of those things. I think there's a broader debate in the industry about assurance, be it internal or external, when it comes to sustainability data, which is not, we're not even talking about forward-looking data, right? We're talking about backward-looking data, and still you have this conversation. When you start talking about forward-looking data, I think ultimately the exercise for investors as we're thinking about ESG issues is in many ways forward-looking. We want to understand how the business model changes. And so, like, might it be false? Well, I think even in a similar way of looking at and thinking about, it's what the company says they plan to do, what they can do, what they expect their strategy to look like. All this stuff may sound like it may sound correct, or it might not make sense at all, but we still want that information out there. And then once we see that information, we can start talking to companies about it. And so I think, especially as you start moving to forward-looking views of how a business might evolve, it is going to be more difficult. But as you're thinking about what you want a board to be thinking about when it comes to strategy, when it comes to how they adapt to climate risk, you want them to be able to think about it. You want them to have views on what to do with the transition. And maybe investors might disagree with what a company is approaching, but still want the information out there.
Before Grace, sorry, because I have my views, and I'm sure you have some valid points to make. But leveraging on this question, let me rephrase it. So investor would want higher visibility, and these are risk elements, and we are hoping and we are expecting companies to make the disclosure. It is okay, not everything being fully audited. Yes or no? So investor would feel the information being meaningful, and it is okay and it's useful. Some of the information need to be audited, but not all of them. Is that a view that you share?
I think it kind of boils down to this external or internal assurance. What are you actually auditing, right? Can you really audit a future statement, or are you auditing the process and framework around that goes into that statement?
I will show you my perspective. The thing about prospectus, the auditor look at every single thing. So prospectus is a risk, it projects, and there are certain numbers need to be audited, but it's not like 100% fully audited in certain ways. There are different type of due diligence. But the market, we got that information are necessary and important. Go on.
It is rather unusual to have a forward-looking statement in prospectuses, actually. I think I can say about this, because I'm not from an accounting firm, I don't have a conflict of interest. I can say where we are going with the disclosure. IFRS Trustee Foundation is working really hard with coming up and harmonizing the disclosure standards. And again, we hope to hear more at COP26, when this new International Sustainability Standards Board will come out with their suggestions of what IFRS or new sustainable disclosure should look like. I think eventually you will need some sort of assurance, because any body at the moment, they can say their carbon footprint can be anything. There's no assurance if the company doesn't go and get one. And on that basis, analysts and asset managers are using whatever the disclosure the company's made to do the analysis of the climate-related risks. And that's not really helpful, really. So I think where the market is going is that I'm hoping that we'll hear more about this at COP26, this harmonization of disclosure.
Right. So I am an accountant, and I of course understand the importance of disclosure, and the questions around risk disclosure. So two things. And I have no conflict. I am a very open-minded person. So the more disclosure, the better. And now at least we have a framework, so people should do the disclosure. And if I go back to the more traditional, numbers type of audit. We do sustainability assurance, and that's no problem as long as things are comparable and there's an auditing standard to leverage. But for people who are wondering or expecting all the carbon relating disclosure, I'm sure part of that will be disclosing, and it's not necessary in a number form. And at the moment, the audit standard, we expect the auditor to say something to the management and flag it to the audit committee if they see something as part of the annual report, which is hugely contradict with what they are performing their work within the financial statement. It's called other information. So that's the current obligation, in addition to the voluntarily companies could auditor to perform audit work properly around that. And in future, maybe when the risks are becoming certain, then maybe the company needs to think about, do they need to make impairment? And that part goes back to the audit financial statement before the IFRS could conclude something. Same thing to the carbon credits. One day it may be booked as intangible assets if a company's get it to a certain number. So the discussion could go on, but personally, and I think that's just one of the examples to see how each party within the finance and accounting sector and each party could play a very meaningful role of this important topic. There's another question. We have a few minutes left. Second question. How does fintech and AI play a role in ESG for buy side? And are you seeing increasing player in this landscape? I think this question is for you.
It does. It's funny because I think if the number of people that I have heard come, I have this new blockchain ESG AI product that's going to change the world. It's almost an endless amount. And so I think when it comes to that conversation, it really is important what exactly it's trying to do, right? Because there's a huge difference when you're talking about AI when it's I'm text scraping a load of news and I'm coming out with an indicator versus I am having some, like, let's say we were looking at kind of the forest land example, like we're using machine learning to understand how soil patterns kind of like there's a lot of different ways when we're talking about this tech. Mm-hmm. But I would say in general that yes, absolutely, there's a huge amount of work and investment on unconventional data because a lot of these questions that I mentioned are really complicated and requires more than information that a company just discloses in terms of how much emits or how much land it owns or what its policy is. You're trying to find different ways, right? And even like kind of even something of some simpler ESG data, which we use unconventional data, like okay, it's very well looking at companies' employee satisfaction surveys or what they put out or what they put out as their policy. It's better to look at Glassdoor reviews and see how what people are actually saying. I mean, of course, there's caveats to every data sources, but you really need to pull out a whole range of data to have a good picture of a company's ESG risks.
Thank you. Grace, you want to add something?
Yes. So as Mervyn just mentioned, looking at all this data, and you do need not just finance people. You need scientists. You need people with the environmental engineering degree, or a biologist, looking at nature-based solutions, and I think I will see this kind of double degrees coming very soon, because it is a very complicated market. And in terms of using technology, I mean, when you're talking about forests, I think you may have drones going over to see that there are really trees over there. But then how do you mark those trees have already purchased by whoever for the carbon credits, and it's going to get really complicated.
I actually was, someone approached us with a similar ask, could we perform audit, and as a forestry, and they have GPS, and exactly the questions that it's just not ready, to ascertain the completeness. We could advise, but to sign off on an auditable opinion of that, even though you have all the Imagine tag, we might not be there yet. But on a but not to make it too sci-fi type of topic. The other day I heard that someone used analytics machine learning to predict the proxy voting of the shareholders of ESG controversies, and that's something new. So huge opportunities out there. I think we, degree or professional qualification, or as simple as day-to-day, we just start putting something together and refine it. It's probably something that I want to share with the audience. With that, I think we are up to our hour long. Any burning remark that the two of you want to make? I think I could still 1-2 minutes.
I think this is, like I said, lots of complex questions, a lot of talent and resources needed. So yeah, if you're interested in sustainable finance, do get in touch.
I agree. Whether we're at the Hong Kong Trade Development Council event here, and they're very good at getting companies to come and invest in Hong Kong and setting up offices. And I do think that we need a lot of expertise from elsewhere, especially Europe, who do have a lot of talent and have experience in doing sustainability for over 20 years. So yes, more talent. Come to Hong Kong. Hong Kong is great.
So with that, I think I must thank the two knowledgeable, very open speakers. I enjoyed a great deal of the last hour. Thank you to TDC for organizing this event. I think the audience, wherever you are, I hope that the last hour dialogue have made you interested in working to any one of us, regionally or globally. And before I wrap this up, thank you for joining today's section. And the Asian Financial Forum will happen in 2022 January. And right after this webinar, there will be a short video that the organizer would want to recap what they did in the last year. Thank you very much.
Co-organised by the Hong Kong Special Administrative Region Government and Hong Kong Trade Development Council, the 14th Asian Financial Forum, AFF, welcomed more than 66,000 viewers from over 80 countries and regions. The two-day virtual forum ran around the clock across time zones and featured a star-studded lineup of speakers and more than 160 influential policymakers, financial experts, business leaders, technopreneurs and economists. They examined the current economic landscape and explored global business opportunities. Themed as Reshaping World Economic Landscape, a discussion of driving global economic recovery topped the agenda. Nobel laureate, economist and policy entrepreneur Paul Romer offered his insights on the topic.
Asia no longer was in the mode of simply catching up with the West, catching up with the United States. 2020 was the year in which Asia significantly outperformed Europe and the United States. As it moves into this era of being at the lead, true innovation becomes more important and harder.
Innovation and technology are the engines of financial advancement and were a key focus at this year's AFF. Two technology trailblazers, Alexis Ohanian, founder of 776, and Luke Julia, co-creator of Siri, shared their insights on investment and innovation. The global pandemic was a wake-up call for a more resilient future and put sustainable investment under the event's spotlight. Our heavyweight speakers emphasized the importance of incorporating environmental, social and governance (ESG) considerations in investment decisions and brought scrutiny to the long-term prospect of impact investing.
More investors are also here to diversify their portfolio and to improve the risk management. No doubt, ESG is a real game changer in the financial industry and is here to stay.
Within pandemic, what we've seen is investors have shown increased interest in impact investing. They want to understand what the opportunities are and how they can engage. And I think that's the real opportunity for us in the field as practitioners, for finance professionals, is how do we turn that interest into action?
The AFF connected investors, project owners and startups from around the world through virtual exhibition and the deal flow matchmaking session. Over 600 investment projects were presented and more than 700 one-on-one matchmaking meetings were arranged. These exchanges and discussions shed light on the actions necessary for a better and more prosperous future.
You know, it's very good to have meetings like this where people come together and talk about these issues, about technology, the financial sector, and both
the profit opportunities they provide, but also the broader social effects that they'll have. So it was a great meeting, and I think I'd be happy to participate in another one like it.
After 14 years, the AFF has become a mainstream international financial forum, always at the beginning of the year, so we are able to afford our participants an opportunity to feel the pulse of the world.